Word on the street is buyer demand is starting to pick back up again. Inventory is still on the rise, and interest rates are on the decline. What does all of this mean to you? Well, that's what we're going to cover in today's video. I'm going to go through what rates did this week, how Fed Chair Powell set new expectations, and how increased buyer and seller activity is starting to shift the housing market. My name's Nicole Rueth, and I've been a mortgage lender for over 23 years. And this channel, my channel, is all about educating buyers and sellers on how to navigate this crazy real estate market. And if you're just finding me and you find value in this content, please give this video a thumbs up and subscribe to the channel to stay updated on everything real estate related. So why is everything that I just mentioned important? Because while right now might not be the right time for you to buy, for the 17% of Americans who believe now is a good time to buy, it smells like opportunity is brewing in the housing market. And I'm not just saying it. Recent data is showing it. What numbers am I watching? The little ones. The ones that are showing a slight turn in the real estate market. I've been known to say once or maybe twice that you can't catch a ball when it hits the ground, only on its way down or its way back up. The ball appears to have hit the ground and has started its bounce back up. So what does this mean for you? More buyers are coming back into the market. Home price appreciation is on the rise and multiple bids on the right homes. All of this is not going to happen overnight. So I'm certainly not going to sit here and be a town crier. But the shift is happening. So let's go through the numbers that I'm seeing and dive into the change and what ultimately it means to your ability to build wealth through real estate. On August 23rd, Fed Chair Powell made headlines while at Jackson Hole, finally putting a flag in the hills stating it's time for the policy to adjust. I want to share where investors think the market is headed from here, given his speech. But first, let's consider what happened up leading to this day. Markets move, as you know, based on expectation, not necessarily based on reality. The market had already been expecting the Fed to start cutting rates in September for quite a hot minute now. This investor exuberance gave July the lowest mortgage rates we've seen since February, resulting in the national average 30-year fixed mortgage rate dropping from 7.14 to 6.7 during the month. Lower national interest rates led to a pop in both existing home sales and new home sales, per reports just released late last week. Existing home sales rose 1.3% from June to a seasonally adjusted annual rate of 3.95 million, stopping a 4-month sales decline that began in March. While still down year over year, this increase in demand yielded a 4.2% year-over-year rise in home prices, making it the 13th straight month of home prices going up. New home sales also saw an increase in July, with an even bigger jump of 10.6% from the previous month and 5.6% from a year ago, as buyers flocked to new builds with, of course, lower interest rate buydowns and builder incentives. Don't get me wrong. While the numbers are up, the baseline is still historically low. 3.95 million annualized existing home sales against a backdrop of 5 million homes sold in 2022 and 6.1 million in 2021. I mean, that provides a little more perspective. What's also coming off of the very bottom is buyer demand, as measured by mortgage purchase application data. With unemployment jumping to 4.3% and only 114,000 new jobs created in July, as reported on the first Friday of August, we saw rates drop again from 6.7% down to 6.3%, creating a massive affordability pop for current homeowners who had been locked in with a rate above 7%. Refinance applications jumped to a 2-year high that week. Homebuyers also started to take notice as mortgage purchase applications squeaked up a 1% week over week immediately following the unemployment report. Then 5% the very next week. Small incremental changes to historically low levels. While home sales, both new and existing, as well as mortgage purchase application data, is hovering at all-time lows, these small increases are starting to show a return of buyers in a transactionally depressed market. Okay, now let's change the lens and take a look forward. Fed Chair Powell noted that a further increase of unemployment nor a further loosening of the job market is needed in order to start reducing the currently restrictive federal funds rate. And as everyone expected, he acknowledged a Fed rate cut is expected at the September 18th Fed meeting. What Powell did not say is how much nor how fast further cuts would come in, as the Fed would remain, as they have been, data dependent. The market, however, did make some immediate assumptions. Following the Jackson Hole meeting, Fed futures predicted 100 bips or 1% drop in the Fed rate by the end of 2024 and a 75% probability of a 200 bip or 2% drop by next June. While the 30-year fixed mortgage rate does not move exactly with the Fed rate, they are certainly related cousins. As the Fed rate drops, or more importantly, as the anticipation grows of a Fed rate drop, our 30-year fixed mortgage rates will drop as well. It's important to point out that with small movements, i.e. from 7.1 to 6.7, there was incremental increases in activity and demand. With larger movements on the horizon expected, those increases will be incrementally larger, since a 1% drop in rate will likely open the door to 5 million more buyers to become eligible to purchase a home. As spring approaches and seasonally home buying demand naturally increases, coupled with the potential for lower interest rates, the spring could be set for quite the housing market frenzy. I will be keenly watching the PCE report later this week, as well as the jobs report and unemployment reports on September 6th. These data points will likely impact the Fed's decisions. Stronger jobs will lean into their decision to only drop the Fed rate a quarter, while a wildly weaker jobs report or another big jump in unemployment could force their hand for a 50 bip cut. But that's still unlikely. This Fed will not want to cause panic with any big rate movements. They've proved to be highly data dependent and slow to move. Personally, I forecast 25 bip cut at each of the next 3 Fed meetings, fulfilling their prediction at the beginning of the year of the 3 rate cuts in 2024. Then I foresee another 4 rate cuts by the end of 2025 and another 2 by the end of 2026, giving us a smooth decline in mortgage rates and ultimately their intended soft landing. Meanwhile, home prices, which have languished near flat here in Denver in 2024, will start their more traditional rise as inventory is absorbed. Now is not the time for everyone to be a buyer, but it's a great time for the right buyers, knowing that come spring, Denver could be returning to its more traditional buyer's market environment. With all of that being said, I would love to know what you're seeing in the real estate market right now. And if you're a buyer waiting on the sidelines, what do you need to see happen in order to move onto the playing field? Or on the flip side, if you're actively looking to buy now, why are you buying versus waiting? I'm always curious what you're seeing. So do me a favor and let me know in the comments below. And if you want to take your insights further, check out this video I have linked in the screen now, and I'll see you next time.